So, when you think about making banks safer, the playbook since 2008 seems pretty simple, right? Just force them to hold more capital and more liquidity. But what if it's not that simple? What if these two pillars of financial safety have a much more complicated, maybe even a contradictory relationship? Well, today we're diving into some fascinating new research that really challenges that core assumption.
Our guide on this journey is a paper from the European Central Bank Working Paper number 3134. It's called A Study on the Interaction of Capital, Liquidity, and Bank Stability. And it's by Francisco Javier Población García and Nuria Suárez. Let's dig into what they found.
All right, let's just jump right into the abstract. The authors say, our results show that both capital and liquidity increase bank stability. Okay, no surprises there. But then they say, however, the joint interactive effect presents a negative coefficient indicating a potential substitution effect. And they add that market power might be the mechanism behind it. So, right off the bat, we have our central puzzle. Capital is good, liquidity is good, but when you put them together, they might start working against each other. Huh.
To really get our heads around this, here's our roadmap. We'll start with the regulatory backdrop, then we'll look at the data and the model they used. From there, we'll unpack that surprising substitution effect, investigate this whole market power idea, and see why context is absolutely everything. And finally, we'll land on what this all means for creating smarter regulations.
So let's start with Section 1, the Stability Mandate.
Look, it's no secret that ever since the 2008 global financial crisis, the name of the game for regulators has been simple: beef up the buffers. Frameworks like Basel III have been all about forcing banks to hold way more capital to absorb losses and a lot more liquid assets to meet their short-term bills. The idea has always been, build a more resilient system. But this paper really asks, is that the full picture?
So how exactly did the authors get to these pretty bold conclusions? Well, that takes us into Section 2, the data and model. This is basically the engine room of their entire study.
And the scale of this research is just massive. I mean, they didn't just look at a handful of banks. We're talking about over 16,000 different institutions across 27 countries, and they looked at them over the crucial decade from 2013 to 2023. This is a huge data set.
And this table really gives you a sense of the depth here. They pulled data from sources like Orbis and the World Bank to get over 61,000 individual bank year observations. The key variables are pretty straightforward. Capital is just equity to assets. Liquidity is liquid assets to total assets. And to measure stability, they use the Z-score, which is a standard metric where a higher score means the bank is safer, a lower probability of default. So they really built a solid foundation for their analysis.
So they've got all this data. How do they connect the dots? Well, they used a linear panel regression model. Now that sounds complicated, but the idea is simple. They tried to explain bank stability, that Z-score, by looking at capital, liquidity, and, this is the secret sauce, the interaction between the two, all while controlling for a ton of other factors. It's this statistical tool that lets them isolate the unique impact of each piece and their combined effect.
And that brings us to their central finding in Section 3, a surprising substitution. Because while the individual effects of capital and liquidity were exactly what you'd expect, the way they worked together was not.
The conventional wisdom is just more is better. More capital is good. More liquidity is good. So if you just pile on more of both, things should just keep getting better and better. But this paper finds something totally different. It finds that while, both are good on their own, they actually act as substitutes, which means the extra safety benefit you get from adding more capital is actually smaller when the bank already has a lot of liquidity and vice versa. And here is the statistical proof right from their results. Just as you'd expect, the coefficient for capital's effect on stability is positive and significant. Same thing for liquidity. But look at that interaction term, capital times liquidity. The coefficient is negative and significant. That right there is the statistical smoking gun for a substitution effect. Think of it like this: airbags and seatbelts in a car. Both are great safety features, but the added benefit of an airbag is way bigger if you're not wearing a seatbelt. If you're already buckled in, the airbag still helps, but its marginal benefit is lower. They substitute for each other.
Okay, that leads us right into Section 4, the market power channel. Because the next obvious question is, why? Why on earth would two good things start to work against each other? What's the mechanism here?
And that's exactly the question the paper sets out to answer. Once you find a strange effect like this, the next logical step is to figure out what's going on under the hood.
To figure out the why, the authors do something really clever. They use a two-stage analysis. We can think of it in two simple steps. First, they check to see how capital and liquidity affect a bank's market power, which they measure with something called the Lerner Index. Then, for step two, they see how that market power, in turn, affects the bank's stability. It's a neat way to trace the entire chain of events.
And the finding is pretty wild. It turns out market power is a key piece of the puzzle. Here's how it works. Having high levels of capital and liquidity can actually boost a bank's market power. But, and this is the big twist, the study finds that more market power is actually linked to lower stability. This really supports the competition stability view, which is the idea that when banks get too powerful and face less competition, they might feel a little too safe and start taking on crazy risks they otherwise wouldn't.
But the story doesn't stop there. As we see in Section 5, context is always key. It turns out this whole substitution effect isn't some universal law of finance. It actually changes depending on the kind of bank we're talking about and the country it operates in.
At the individual bank level, things get nuanced. The positive punch from having more capital, it's strongest for smaller, more efficient, traditional banks. Liquidity, on the other hand, seems to be most important for the inefficient banks. And that substitution effect we've been talking about, it's most obvious in those same inefficient banks. Which makes sense, right? For them, the cost of holding both high capital and high liquidity can be a real drag on profitability.
The country matters too. Capital does a better job of stabilizing banks in countries that have strong institutions, rule of law, financial freedom, that kind of thing. The substitution effect is also stronger in these places. But here's an amazing exception. In places where the banking sector is super profitable, the relationship can completely flip. Capital and liquidity can actually become complements working together. Maybe when banks are making tons of money, the cost of holding both buffers just isn't a big deal, and they can work together to make the bank even safer.
So, with all that nuance, what's the big takeaway? Well, that brings us to our final section, smarter regulation. Let's just do a quick recap of the key conclusions. 1. Capital and liquidity both make banks more stable, just like we thought. 2. But they act as substitutes. The benefit of one goes down as the other goes up. 3. Market power is a major reason why this happens. And 4. This isn't a one-size-fits-all rule. It all depends on the specific bank and country we're looking at.
And the authors themselves really drive this home. They write, the empirical evidence obtained in this paper may have important policy implications. They're basically saying, hey, this isn't just an academic thought experiment. This has direct, real-world relevance for how we keep our financial system from blowing up.
So the bottom line is this, a one-size-fits-all approach to regulation, where you just tell every single bank to pile on more and more of both capital and liquidity, that's probably not the smartest or most efficient way to do things. The details really, really matter.
And that leaves us with a really critical question for policymakers. If just piling on more of everything isn't the best path to stability, then how can regulators design rules that are actually smart enough to account for this substitution effect and for the specific context of every bank? Now that is the multi-trillion-dollar challenge this research throws down for the future of financial regulation. Thanks for tuning in.